If you're a business owner in Canada and you're looking to purchase life insurance, you probably wondered, should I buy it personally or should I buy it in the corporation? Now, there's many strings attached to buying it in the corporation. However, there's a lot of beneficial things that happens when you do buy it in the corporation. So in this video, we're going to go over the basics of how it works if you corporately own life insurance, some good things that can happen with it, and some bad things that you need to be aware of. And make sure to stick around to the end because the last one is the most important, and make sure to figure that one out. What's up, guys? For those of you who do not know me, my name is Philip Setter. I'm the founder and CEO of Affinity Life, where we've helped hundreds of Canadians find the right life insurance coverage at the right price, all from the comfort of their own home. So if that sounds interesting to you, I'll put the link in the description below. But without further ado, let's get right into the video. So first, let's just go over the two basic types of life insurance, because depending on which one you pick and put in a corporation, there's different strings that are attached to it and it works a little bit differently. So the first one is term life insurance. Now, term life insurance is the easiest type of life insurance to understand. You'll know if you watch this channel for any number of time that it's probably my most recommended type of life insurance. It's there to cover you for that specific period of time, usually 10, 20, or 30 year. After the term is done, you can cancel it or you could renew it. Usually you cancel it. So it's just used to cover yourself when you need it the most. So, maybe in a business, that's when your business is growing. Maybe you have a key employee that you want to get it on. Maybe you have partners in your business and you want to fund some type of buy-sell agreement. I'll talk about that a little bit later on in this video. And it's the most inexpensive option. Now, permanent life insurance, on the other hand, is meant to cover you until death. So we have two different types here in Canada. We have whole life insurance and universal life insurance, and they both work relatively the same within a corporation. And now this type of insurance is meant to cover you until the end. Now, there's really two main uses for permanent life insurance within a corporation. The first one is for estate planning. So just like an individual, you're going to have taxes upon death. Within a corporation, there's definitely going to be taxes upon death, especially if you still hold those shares at death. And that's a little bit more complicated than I'm going to get into in this video. However, if you plan on holding your corporation until you die, which a lot of business owners do because they have a lot of retained earnings in there, or maybe real estate, or maybe other investments that they want to pass down, then having life insurance to cover off those estate planning goals is very important. The second reason that you will want to have permanent life insurance in a corporation is for all the unique tax strategies that go around with it. Now, I'm not going to get into all of them in this video. However, I will go over a few. There's many different ways that you can use permanent life insurance in a corporation to facilitate a number of different things. So one of them could be saving for retirement and having what I call a buffer asset during retirement. That's where you can pull an income from your life insurance policy and it's not correlated to the market. If you follow this channel for a while, you know that 9 times out of 10, I'm very against this strategy. And I say that term life insurance is the best option and you should avoid buying permanent life insurance. However, I will say this. I always say that for the high income earners of Canada, it could make sense. And I'm going to go one step further. For the high income earners that are business owners, it even makes way more sense. And this is a fantastic strategy. And I'm not going to get into it in this video. If you are interested in a video where I really go into the tax strategies of how that would work, drop a comment below, just saying, ask for, corporate investment or corporate life insurance investment, and I will make that for you. Okay, let's just go over the corporate life insurance basics, how it works with term life insurance, with permanent life insurance, who the payer should be, who the beneficiary should be, who the owner should be, what kind of tax issues arise, how you get that money out of the corporation, and a couple more. So let's get into it. So number one, let's just go over the setup. 9 times out of 10, I would say even more than that, 99% of the time, this is how it should always be set up. So the corporation should be the owner of the policy. Even if the intended beneficiary will eventually be your family, maybe you're just using your corporation to pay for life insurance through the corporation, but it's still going to be for personal use. Doesn't matter. The corporation is always going to be the owner of the policy. It's going to be the payer of the policy, and it's going to be the beneficiary of the policy. However, you're going to be the life insured, assuming that you're, the shareholder of your company or the owner of your company. And so this is the reason why. So let me explain how it works if you did pass away. So upon death, if you just had personal life insurance, it's very simple. The life insurance proceeds would go to your beneficiary. It would be 100% tax-free, be super easy to understand. In a corporation, it works a little bit differently. So if you did pass away, the corporation would then receive the death benefit. So whatever that is, maybe it's $1 million. Let's just say it's $1 million to make matters easy. So now the corporation has $1 million within the corporation. And so you're probably thinking like, okay, well, that's great, but how do I get it, obviously to my wife or to my husband or to my kids or whoever you wanted it to go to in the end? Well, here's how that works. So there's a mechanism within a corporation called the capital dividend account. I don't want to get too complicated on you guys. All this account is essentially a way for you to pay dividends to shareholders tax-free. Now, this is how the equation works with life insurance. The face amount minus the ACB, the adjusted cost basis of the policy, is going to equal your CDA. Now, you're probably thinking, what the hell did he just say? Let me explain it to you. So let's just say you had that $1 million death benefit in a term life insurance policy and you passed away. Well, there's no ACB within term life insurance. And I'm going to explain permanent life insurance here in a sec. but there's no ACB with term life insurance. So how it would work is $1 million minus zero is still $1 million. That would then get paid into your corporation, and it would create a corresponding $1 million CDA balance. So what does that mean? Well, that means that now the corporation is eligible to pay out $1 million tax-free to shareholders. Now, depending on how your corporation is set up, maybe you are 50-50 with your partner and they're in the business. Maybe you're just 100% owner of your corporation. So depending on how it was set up is how you'll have to figure out how you're going to pay that dividend out. With 50-50, it's, quite simple. However, here's the thing. If you were 100% shareholder of your company and you're with your partner, upon your death, assuming that you have a will set up, they're going to be the intended beneficiary of your shares. And once they have the shares of the corporation, then they can pay out that tax-free dividend. Now, you're probably wondering, can I just not simplify this process and make my partner, my wife, my husband the beneficiary? And, because it's going to be the intended beneficiary anyways, why do we have to go through this big rigmarole and, it's a complicated process? Do not do that 100%. If you designate another individual, a personal individual, and not your corporation, however, you're paying for it corporately, you will receive what's known as a taxable benefit, which is incredibly bad. Well, you won't, you'd be passed away, but your partner would, and they would receive $1 million, and then that would all be allocated as a 100% taxable benefit, and then have to pay like $300,000 or $400,000 of tax on that. So don't do that. There is a mechanism to pay it out tax-free, although, you can see it's a little bit complicated, but I hope I made it a little bit clear. Now let's talk about permanent life insurance, because I mentioned that there is some ACB with permanent life insurance. So here's the thing. The ACB, which is the adjusted cost basis of a life insurance policy, and a permanent life insurance policy specifically, is a little bit complicated. However, here's a general rule of thumb. As you start to buy your permanent life insurance policy, maybe you picked a whole life 10 pay or 20 pay, for example. In those years that you're going to be paying your premium, the ACB of this policy is going to go up, which is a bad thing because that means that's less and less CDA that we have available if you were to pass away. As you get older, however, the ACB will start to go down because what's known as the NCPI, the net cost of pure insurance, and I hope you're still with me, pardon me, that starts to go up. The actual cost of insurance for the insurance company, starts to go up, and that drives the ACB down. So when you're paying your premiums, it goes up. As you get older, it goes down. I hope that made sense to you. So what does that mean? Well, with a permanent life insurance policy, if you were to pass away, unfortunately, early, let's say you bought it when you were 40 or 50 and you passed away when you were 60 or 65 or 70, chances are there will be some ACB in that policy. However, depending on how the policy was structured and how it works, hopefully your ACB should be down to zero by time you're 80 or 85 or 90. And so if you die when hopefully you intended to die, there'll be no ACB within that policy, and it will be 100% available for CDA payout. Okay, so let's go over the tax planning within a corporation now and how that works with life insurance, because you're probably wondering, why do I even buy it in a corporation? This seems super complicated. Maybe I'll just buy it personally. So the number one reason why you would want to buy life insurance within your corporation is just because it's cheaper to buy within your corporation. Here in Alberta, we have like a 9 or 10% small business tax rate. And personally, depending on how much you are paying and how much you're taking as an income, you could be paying up to 40 or 45 or even 48% in taxes. So obviously it's way cheaper to have it in the corporation and pay for it corporately. Now, the other reason why you'd want to have it in a corporation is to fund a buy-sell agreement. Now, a buy-sell agreement is essentially an agreement that says if you have other partners within your corporation, other shareholders, you have a mechanism to buy back those shares. Now, this is incredibly important because if you started a business with other partners, let's say you have 2 other partners, so there's 3 of you in the business and you own all 33.333%, and one of you were to pass away, well, you got into business with your 2 partners. You didn't get into business with their spouses, with their husband, with their wives, with their children, whoever it is that would be next in line to receive those shares. Because if they were to pass away and you had no buy-sell agreement in place and you had no way to fund it as well, well, then the next of kin would be receiving those shares, and now you're in business with the next of kin. And so there's really 3 ways to buy those shares back. The first way is to get a loan from a bank and buy them with a loan, but now you have to pay the loan off. The second way is to use capital that you have in a business, but of course, now you're out capital that you have in a business. The third way is to buy life insurance and pay for it then with life insurance. And life insurance, term life insurance specifically, is incredibly cheap. So you should absolutely get it to cover off the partners in a business if you do have partners, because if one of them are to pass away, you would want to have a mechanism and the funding in place to be able to say, hey, no worries, sorry this happened, here you go family, here's $1 million, let us have the shares back. Now you and the other partner are 50-50 in the business, the family gets paid out for the worth, and you're not in business with someone that you don't want to be in business with. So having that in place is a very good idea. Now there's one more thing that I'm going to talk about here in the tax planning section is deductibility of life insurance. I get asked this question quite a lot from a lot of different people saying, well, it's in my business, can I write off the life insurance premiums and can I deduct that from my income? The answer is no, most of the time. Let me explain. There is only one very specific circumstance in which you can write off the premiums of a life insurance policy. And by the way, this is not just corporately, this is personally as well. So it doesn't matter how you own the life insurance policy. So here's how it works. If you get a loan from a lending institution and a requirement of the loan is that you purchase life insurance to cover off this loan, okay? So you go to, I don't know, BMO, RBC, any one of these lending institutions, they say, yeah, we'll give you this $1 million loan. However, you have to have life insurance. Well, if that's the case, then one more caveat is satisfied, and that is that you use this loan for the purposes of producing income or investments, then a portion of the life insurance premium can be deducted. So just to sum up those two things again, number one, it has to be a requirement for the loan, and number two, the loan has to be used for business or investment purposes. Now, here's how the deduction works. So you actually can't deduct the entire premium. You can deduct a portion of the premium known as the NCPI, and that stands again for the net cost of pure insurance. And depending on whether it's term life insurance or permanent life insurance that you have, that number will vary. Most of the premium for term life insurance is the net cost of pure insurance. However, with permanent life insurance, it's a much smaller amount because we know we have that investment component that is attached to that permanent life insurance policy. So with term life insurance, it is most of it. And you can get that number, by the way, from the insurance company. And now, one more small thing, the amount that you can deduct is prorated to your amount of life insurance. So for example, if you have a $1 million loan and you have a $1 million life insurance policy, that means that you can write off 100% of the net cost of pure insurance of that life insurance policy. However, if you have a $1 million loan and a $2 million life insurance policy, you can only deduct 50% of the net cost of the insurance within that policy. Okay, so I'm going to wrap this video up with just two major concerns that you need to think about if you are considering purchasing life insurance within a corporation. So the first thing I'm going to say, term life insurance has very little problems in a corporation. 9 times out of 10, again, it's easy, it's simple. So if you're thinking about doing, a buy-sell agreement or maybe getting life insurance on a key employee, and if they were to pass away, the business would be very financially impacted, then you don't have that many things to worry about. However, permanent life insurance, on the other hand, is a completely different story and it can get very complicated. So I'm going to go over a couple things here. Number one, permanent life insurance, we know has that investment component attached to it. And now here's the thing. If you bought that policy personally, there would be creditor protection. Your creditors cannot go after a life insurance policy. However, within a corporation, they can actually go after that cash surrender value or the investment fund if it was a UL. So that's one thing to keep in consideration. There's no creditor protection for this asset. Now, that's not the biggest problem, however, with permanent life insurance in a corporation. The biggest problem with life insurance in a corporation is if you ever want to move it. Now, here's the thing. Why would you want to move it? There's a couple reasons that you may want to move that life insurance policy. Maybe it's in an operating company and you want to move it to a holding company. Maybe you want to move it to a sister company. Maybe you wanted to sell that corporation. Maybe you wanted to wind up that corporation. You were just done paying for the cost of having that corporation open. It's no longer in business and the funds are all out of it. Here's the thing. Transferring life insurance is super complicated. And not only is it complicated, but the taxable events that happen when you transfer it are incredibly high. There's so many layers of taxation. The original corporation would get taxed. Whoever that life insurance policy is going to could get taxed. So it's super complicated and it negates any benefit that you may have in the first place of buying a permanent life insurance policy. So if you had any plans to sell your corporation or shut it down or anything like that, you want to make sure that you're not putting your permanent life insurance in that corporation. Now, I would say, where do you put it? That's another discussion all on its own. Corporate structures and creating holdcos and family trusts and investcos is a totally other topic, and it can get quite complicated and quite expensive. However, for some people, it may be worth it. So with all that being said, I hope that I was able to answer some of the questions about having life insurance within a corporation, having life insurance as a business owner. If this is something that you are thinking about doing, I would say make sure that you work with a professional that doesn't only understand life insurance, they understand corporations and businesses and how the lifetime capital gains exemption works and how the transfer of life insurance works. And they really are in the world of business, because most life insurance agents don't understand this stuff. They understand life insurance. They don't understand corporations. And there's a lot of problems that can arise. So make sure that you're working with someone that is very competent in this area. And of course, if you guys want to have any questions answered, you want to book a meeting with me, you can go to the website and do that. But with all that being said, I hope that you guys enjoyed this video. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.